In part one of this two-part series on Dreamfinder Homes, we covered why this company is in the right place at the right time. We also went over why DFH would be a strong beneficiary in a potential real estate market decline in the US. The only problem that we ran into is that the share price at $21 a share is really high relative to the intrinsic value that we calculated, which is approximately $28 a share. And you can grab the free to download model where we did the work in the description below. But guys, just because the share price is a little bit too high right now doesn't necessarily mean that we have to walk away from this opportunity. I'm seeing some interesting things with cash secured puts and covered calls on this name, and that's what we're going to dig into in this video. You're watching More Money, let's get it. What's up guys, Tay here, and you're watching the #1 channel for people that want to retire early. I truly believe that I provide some of the best due diligence on investing here on YouTube, so I'm glad that you've decided to join me. As I said in the intro, I found that buying shares in Dreamfinders at $21 a share was a bit too expensive, as it was approximately 75% of what I calculated to be its intrinsic valuation. Oftentimes I run into situations where a company will pass on the first 3 questions of the Buffett 4-question system, but will fall on the last one, which is it selling for a compelling valuation? Personally, I really like to buy stocks when they're trading closer to 50 to 60% of their intrinsic value. Now, when I was younger, I would just throw my hands up in the air and walk away from stocks that weren't cheap enough. But since then, I've learned a lot more and found that in some instances, there were other types of opportunities in the stock option world. Now, before I dive into what I see within the options world relating to Dreamfinders Homes, guys, note that you have the ability to exercise the options to smash that like button. It really helps YouTube know that this channel provides valuable content, and thus you'll share it with more viewers like yourselves. Okay, so what do I think about the stock options with Dreamfinders Homes? I do have some generic general rules when buying up stocks. In something similar to March of 2020, we can find situations where the share prices fall between 0 and 25% of their intrinsic value. In this type of situation, I get very greedy and I use up to 80% of my funds to buy equity, and I put approximately 20% up to purchase long-term out-of-the-money call options on the position. Call options are the riskiest type of option security that you can purchase because you can make a lot of money on it, but you can also lose 100%. So I only use call options sparingly in black swan type situations. If the shares are trading between 25 and 50% of their intrinsic value, I will usually just purchase the shares outright. In some situations, I'll purchase up to 10% of the position in the form of long-dated call options, or more commonly, I'll sell out of the money cash secured puts to take advantage of immediate position compounding. Now that's a bit more of a complicated concept and it's a bit out of the scope of this video, but note guys that in October, I will be making a new video series on option strategies specifically for value investors. So look out for that by subscribing to the channel and hitting that notification bell to be notified when those videos become available. Finally, when the stock is trading higher than 50% of its intrinsic valuation, I like to see if there's an opportunity where I can sell a cash secured put at a lower price, which is approximately 50% or less than its intrinsic value, and simultaneously generate a premium that is approximately 25% or greater on the locked up funds. Just a reminder that when you sell cash secured puts, you can be called on them if the share price falls. So you always have to have the funds available to buy the shares at the stated price. And so if you have to park those funds and make them available, then you need to generate an acceptable level of return on them, which is why I look for approximately 25% or more in annualized premium yield. Okay, now this was a lot of mumbo jumbo, but let's see it in action. I'll start with the cash secured put opportunities. From here, we can see that the January 21, 2022 17.50 strike price cash secured puts with a premium of $1.40 are yielding an annualized 22%. And if you get called, you have a net basis of $16.10, which is just the 17.50 minus the premium of $1.40, which is 58% of our valuation. So you are covered on the downside. The $20 cash secured puts with a $2.50 premium are yielding an annualized 34.3%. And if you get called, you have a net basis of $17.50, which is 63% of our valuation. So you're covered on the downside, and this is still really good. Obviously, the downside protection is greater with the lower strike price, but the 34% annualized premium on the $20 strike price more than makes up for it. If we push that strike date out to April 21, 2022, we see the following. The $17.50 cash secured puts have a $2.50 premium, which are yielding an annualized 24%. And if you get called on those cash secured put options, you will have a net basis of $15, which is approximately 54% of our $28 a share valuation. So this is exactly what I'm talking about when I say don't just walk away if the share price is too high. By checking the yields on the cash secured puts, I just found a potential opportunity where we are getting a very good locked-in premium yield of approximately 24% annualized, and we're being covered on the downside because the net basis of $15 represents 54% of our intrinsic value of $28 a share. So I have to say that this is a very compelling opportunity. The only problem is that I'm not really sure that we can get it right now. There doesn't seem to be a lot of open interest. I put in a couple orders and none of them got filled. So to me, the opportunity looks like it's theoretically there, but we'll have to keep an eye on the volumes. Or we can just use the $20 strike price. The volumes are there for that one. Now, some of you may not like cash secured puts and are more comfortable with covered call opportunities. I look at those too, so let's look at them together. When we look at the January 21, 2022 strike date, the $25 strike price is giving you $1.75 in premium, which gives you an annualized covered call yield of 23%. And if the share price runs, you get exercised at an annualized 77% return. That's not too shabby, and the downside risk based on the current share price of $20.88 and a premium of $1.75, you get a net share purchase price of $19.13, which reflects 68% of the valuation. To me, that's a bit high. I would like to see that under 60%. So let's take a look at the April options chain. So the April 14th, 2022 strike date, the 22.5 strike price for covered calls have a premium of $3.40, which are giving you an annualized cover call yield of 27.5% on the current share price of $20.88. And if the share price runs, you get an annualized return of 40.6%. That's still in the very, very good territory. The point to those that are just learning options, the further you go out in your strike date, the lower your annualized return usually is. But that's offset with you getting a higher premium now. So there's an optimization challenge that you will have to solve for yourself. And before some of you more experienced investors kill me in the comments, can we just agree that there really is no right or wrong answer? How far out you go to buy the options really depends on the investor's objectives, style, risk tolerance, and portfolio strategy. Okay, so let's look at the downside risk here of the covered call that I just mentioned. If the share price runs lower, your net purchase price is $19.10, which reflects 68% of the intrinsic valuation that we calculated earlier at $28 a share. Once again, to me, that's a bit high. I would like to see that under 60%. So the covered call opportunities are not really for me here. Or in other words, I'm not really interested in them. So if I would have to conclude, I personally really like the cash secured put opportunity with the April 21 1750s with a premium of $2.50 per share. I like them because I really get good downside protection where my net purchase price is under 60% of the intrinsic valuation, while simultaneously getting a good annualized yield of 24%. I'm really well optimized there. And that, guys, is my kind of opportunity. It just looks like the volume isn't there for me right now, but this can pick up very quickly. So I'm going to keep watching it and hopefully something opens up for me. It usually does. I am in a ton of cash at the moment, but it's not burning a hole in my pocket, as you guys can imagine. As I see the opportunities come up, I will invest. Otherwise, just like a fisherman, I'll just enjoy the day out there on the boat. I hope you guys gained some real value from this series. In the next series, I'm going to be covering progressive insurance. So in order for you guys to not miss out on that video, please consider subscribing to the channel and hitting that notification bell to be notified when I upload that video. As always, guys, I sincerely appreciate all of you, and I can't believe that this channel is growing at the rate that it is. Thank you from the bottom of my heart, and I'll see you later.